Welcome everybody. Today I want to talk about a very important aspect of trading, and that is protecting your hard-earned money. The stock market is not the easiest place in the world to make money. It's very difficult, and when we do succeed and we are successful, when we have a downturn in the market, and these downturns happen all the time, we want to protect our money. And the way I protect my money is that I hedge it as soon as I see the market turning around. This is an investment strategy intended to offset potential losses. A lot of people that have a larger portfolio might just stay in the market and allow it to make a correction and then have it come back up, and that's a different breed of cat. I mean, you've got to be, you can't be anxious about your trading. You can't lose sleep over your trading. The market most times will come back, especially when we're in a bull market, and indeed we are in a bull market, even though this is a very volatile time. So this strategy is to protect your portfolio when the market does turn around. This is going to allow you to sleep better at night. This is going to allow you to have less anxiety. This is going to allow you to step back when the market has a correction. Step back, let it do its thing, and then get back in. Okay, today I'm going to talk about, I just use two indicators. And these are pretty common indicators. One's the exponential moving average line, and the other is Fibonacci ratios. And I'm going to get into a little detail around the Fibonacci ratios. I like to keep my strategy simple. I think the simpler the strategy, the better chance you're going to have to be a success. Then we're going to talk about the hedging rules. I'm going to talk about the fact that when the bull market does correct, it usually is a slow rollover, and you can usually see it happen and prepare yourself for hedging. The timing on hedging is not that critical. When you start seeing the market rolling over, it's really up to you as to when you want to get in and hedge. And I hedge using what's called a protective put. Protective put, and these are, we'll take a look at in the money, at the money, out of the money, and how far out. Which ETFs do you use to place these puts? And then we're going to go over the process. I haven't updated this chart. I'm going to give you an example step by step of how this worked just last week. So Renee said, I've been a trader for 35 plus years. I'm a hedge fund manager, keynote speaker. I've written 3 financial books. Right now, I am very proud of the fact that I am the founder and head trader at Options Infinity. You can reach that at https://optionsinfinity.com. We were just rated the #1 option trading site for educational blogs. I'm about education. I'm about teaching my people what I know, what has been my journey, and this is how I make my living. This is how I've made my living for 35 years. I've got a lot of knowledge in my between my ears, and I like to share that, and I get a big kick out of that right now. Okay, the first indicator that we're going to use is an exponential moving average indicator, and I follow the SPY, the S&P 500. You don't have a better ETF out there than the SPY to follow everything that's going on in the market. And the green line here is just the 8-day exponential moving average line. The gold line is the 21-day exponential moving average line. The premise is that the market, when the market is moving in an upward direction, it will stay above the 8-day exponential moving average line. And as long as you're in that movement, you just stay with it. You just let your portfolio grow and grow and grow. And then when the market starts saying, you know, I'm starting to top out here a little bit, maybe you want to pay attention to me. Maybe you want to put a hedge on. Whoops, now I'm down below the 8-day. Oh, you didn't put it on today? Well, you better put it on tomorrow. Okay, you put it on tomorrow, and you basically allow the protective put to earn money while your portfolio loses money. So you get all the way to the bottom here and you say, you know what? I didn't even know that happened. My whole portfolio was in neutral. I made as much on the protective puts as I did that I lost on my portfolio. And now I'm ready to go again. Only this time I'm going to take what I made on the protective puts, I'm going to reinvest that and buy more, and I'm going to run it on up again, only I'm running it up from this level. Then I'm going to get to the area here and I'm going to say, whoops, okay, this market has been very volatile. I better get out now. And indeed, that was a good idea. Now, just recently, we currently have a hedge on because we are below the 8-day exponential moving average line. The 8-day is the key. The gold line, the 21-day, really is for me to see, yes, indeed, the 8 is crossed below the 21. We're going to be in a little bit of a correction here for a while. You know, just stay with it. Just stay with it. So the 8 and the 21-day exponential moving average line are the first indicators. Pretty simple. Pretty simple. All right. The second thing I look at is Fibonacci extensions, and I'm going to show you how to use the Fibonacci extensions. On this latest move we had just last week, just 2 weeks ago, the market came down, then it retraced back up, and then it came down and made a lower low. It started out by making a lower high. Then it made a lower low. That is the classic definition of a downtrend. Lower highs, lower lows is the definition of a downtrend. Now, it's called a measured move. Once I have that measured move, I can come in and put a Fibonacci extension going from the top to the bottom to the retracement point, and most of the trading platforms today will place that on your chart automatically. I follow the 127 and the 161, and it is uncanny how accurate this is. Well, you can see in this example, it came down within a tick of the 161 and then it recovered, okay? But from here to here, we had protection on, and I'm going to show you that later on. Now, let's talk a little bit more about, excuse me, measured moves. Again, the definition of an uptrend is higher highs and higher lows. The definition of a downtrend is lower lows and lower highs. A bullish measured move goes from the low to an intermediate high to a higher low to a higher high. That is a measured move to the upside. An upward trend can have any number of these measured moves, and that just shows confirmation that yes, indeed, we are still in an upward trend. It's independent of the time you're looking at. You can see these on a 1-minute chart. You can see these on a monthly chart. Okay, I follow the daily chart to determine when I want to put my hedge on. For a bearish measured move, it's just the opposite. It goes from a high to a low, then a retracement, then to a lower low, and this is a confirmation of a measured move to the downside. Lower lows, lower highs, we are in a downtrend, and it will stay in that downtrend until we get this formation to the upside. It's so easy. I mean, a lot of people wonder, what is the trend? Where are we bullish? Are we bearish? In what time frame? The measured moves will tell you exactly that information. It's a very powerful method to determine where you're headed. Now, once you have this measure move, you can apply Fibonacci ratios. The Fibonacci ratio is seen throughout nature. As you go up the stem of a flower, the leaves grow proportional to the distance of the ratio. The ratio is 0.61. The spirals of seashells are in proportion to the ratio. The distance of your forearm to your hand is proportional to the ratio. All the bones in your body are proportional to the Fibonacci ratio. This is not just a mathematical number that somebody, Mr. Fibonacci, pulled out of the air back in the 17th century. This is seen throughout nature. My hand is 7.5 inches. My forearm is 12.3 inches. The ratio of that is 0.61. That is the Fibonacci ratio. It is seen throughout nature. Now, doesn't it make perfect sense that the market, which is fueled by human nature, fear and greed, it would move in perfect harmony with nature? So it doesn't surprise me when the Fibonacci extensions hit the absolute point where the market turns around within a couple ticks. It's just amazing. You look at it, and what I'd like you all to do is go into your trading platform and play around with this and see how amazing this tool actually is, and how you can utilize it to increase your trading. Now, the ratio is derived from a number sequence, and it starts at 0, 0, and what you do is you add the previous two numbers to this, and that gives you this number, 1. 1 plus 0 is 1. 1 plus 1 is 2. 1 plus 2 is 3. 2 plus 3 is 5, and so on. Okay? If you take the current number divided into the previous number, it gives you the root Fibonacci ratio, 0.61. Now, later on, mathematicians came in and they started doing square roots and square of that, and then they took the reciprocals of that, and these are the numbers I use for the extensions. When it makes a measured move, most times, not always, nothing in the market is always. When it makes a measured move, most times it'll go to the 127. Then it makes sense that it goes there more often than it goes to the 161. Makes sense that it goes to the 161 more often than it goes to the 261. But these give you an indication of where you might want to take profits. All right, here are the rules. Here are the rules. And oh, by the way, this is on, you can go on to, I think it's, I forget, Renee, where this is posted right now. Renee will tell you later. But you can go in here and you can take a screenshot of this, or you can just stop it when you're replaying this and write these rules down. Basically, when the price closes, below the 8-day exponential moving average line, we put a hedge on. Then if it goes below the 21-day, yes, you keep the hedge on. If it closes above, you take it off. Okay, you come around here and you do the loop again. If the 8-day crosses above the 21-day and the price closes greater than the 21-day, you take it off. Oops, now the price goes below, you put it on. All right, this is how you utilize that 8-day exponential moving average line. Now, I talked about there's no real panic to put this on, that you usually have time. It usually takes about 4.5 days, and this is on average, for the market, if it's in a bullish state, to roll over and make a correction. Okay, and you can see how it comes up here and kind of flattens out a little bit, and then down it goes. Okay, it comes up, kind of flattens out a little bit, and down it goes. It gives you some time. Gives you some time. Not true about when you have a reversion. When you have a sell-off, in other words, a lot of times a sell-off will come down here and spike, and then back up it goes. Spike and back up it goes. Not true when you're putting on a hedge. You got some time. You can see the market rolling over. You've got some time to put that hedge on. Now this goes back to 2014, and you can see, which was an average year, by the way, and you can see that we had a rollover and a dip 4 times during that year. And the reason I have this up is that is the average. You usually have, even in the strongest of bull markets, you will have on average about 4 corrections of 10% or greater in any given year. Now, last year was extremely strong year, and we only had a couple of pullbacks. So you say, well, I would have been all right just letting my money go through. Well, that's in hindsight. When you see something like this happening, it's like, oh my goodness, is this it? Is this the beginning of the bear market? And oh, by the way, until interest rates get around 4-5%, we will continue to be in a bull market. This is a very volatile time we're in right now, and I am hedging right now, but we are still in a bull market and will remain so until the interest rates get to the point where the big boys can start putting some of their money into long-term treasuries. Just something to keep in the back of your mind. Here was a 12-day rollover right here. It wouldn't have mattered if you put the hedge on the 6th or the 22nd. You get about the same return. This next one shows a 3-day rollover. Actually, if there were 5 days difference here, you got about the same results on March 5th as you did on March 10th. This next one was a 7-day rollover, and you know, it had about the same results even if you waited in. So it's not something that the timing is not that critical. That's what I'm trying to show you here, which is beautiful. Okay, which puts and how far out? The first thing is, you know, you look at this and you say, well, most of the corrections that occurred, believe it or not, 2008, people say, oh man, 2008 was a killer. Yeah, about 2 months of 2008 were a killer. And you might have wanted to go in and get another one for another 2 months, but that's it. That's all. 2007, we had 4 rollovers. 2008 had about 4 months of bad trading, and you want to have that protected. And I use options about 30 to 45 days out until expiration. Okay, so which puts and how far out? If we're looking at 45 days, you just come in here to the option chain. You look for the options that are 45 days out. You go ahead and get those. I like to get them right at the money. Now, what's interesting about that is that at the money, you'll notice that the delta is 0.5. Now, this actually works in our favor because if we buy, let's say we've got 100 shares that we want to hedge. We buy one contract. We buy one contract of the SPY at 200, 30 to 45 days out. This is the insurance you pay. Now the delta is 0.5. So now if it drops, the further it drops, the higher this delta will become. So in other words, when you first buy it, you're going to only get 50% of your portfolio protected. And as it drops, you get more and more of your portfolio protected. That's really beautiful, because if it goes, if you hedge, if you put a hedge on and you're wrong and the market continues to go up, that's okay, because you make money on your portfolio and you're only losing half of it on your protective puts. And the further it goes up, it's less and less. See, the beauty of hedging, there's two things. One, you don't have to be, the timing is not critical. And two, it's a win-win proposition. If you put on a protective put and the market goes down, you are protecting your portfolio on an increasing basis the further it drops. If it goes up, your portfolio is making money and you're only losing on the put, which you can take off at any point in time. Now this is what I showed you on the last chart. Let's say we put on the 200, and we paid $3.22 for that. And let's see, this was on this was back in September 2nd of 14, and I just pull this out. I use this all the time. And this was like about a month later. You can see that the delta is now 1, so you're getting 100% protection. Meanwhile, your put has doubled in price. And I'm going to show you exactly what that means later on. Which ETFs do I use? All right. What you're going to need to do is take a look at your portfolio and decide how many stocks you have in the S&P 500, how many stocks you have that are NASDAQ 100, how many stocks you have are in the Russell 2000, and use the SPY, the QQQ, and the IWM to hedge those. That's going to cover 2,600 out of the 7,500 publicly traded corporations, and I think you're in good shape. For the very, very small cap, for the startup companies, don't even worry. Don't even bother hedging. Don't worry about those. Okay. So by using these three, you can cover most of your portfolio. So you got some work to do. You want to dissect your portfolio and see where you're at. Okay. All right. So we looked at the Fibonacci's and how we could use this. Now this happened just 2 weeks ago. So we came down here, and on March 12th, we put in a hedge. Okay. It closed just right at the 8-day on the I think it was the 9th, and then on the 12th it closed below there. I could have waited till the next day to put the hedge on. Okay, we put our hedge on, down it goes. The 8-day crosses below the 21-day. Down it makes a measured move. Okay, how low is it going to go? Well, it comes down to the 161.8, and you say, well, okay, I'm going to take the hedge off at this point. Now, if you're wrong, you can always just put the hedge back on. This is not the timing is not all that critical here, and your decision is not all that critical. You've got some time, and if you're wrong, you just put it back on. And if the market goes against you, let's say you have the hedge on right down here and you leave it on and the market goes against you. Well, remember you've got a portfolio of stocks that are increasing as the market goes up. So that's beautiful. That's beautiful. And it's your protective put that is losing a little bit, but the net is you're gaining even though the market's going up rather than dropping down. Okay, a couple weeks ago, March 16th, assume you had a $100,000 portfolio, and you can put in any number you've got to make this work. Okay. And the SPY at that point in time was 274. You want to divide the $100,000 by 274 and come up with 365 shares. Now I'm making this simple. I'm assuming that all your money, all your portfolio is invested in the SPY, just to show you how this works. So you have 365 shares right here that you want to protect. Right here, you want to protect those 365 shares. So you buy to open, and you go out about a month, you buy 4, you round this up because each contract is 100 shares, so you're going to buy 4 of them, so you're going to cover 400 shares. Of the 20 April 274 puts, and these are just right at the money, and you're going to pay $3.61. That's $1,444 if it expires worthless, or about 1.5% for insurance. That's pretty cheap insurance. And we're not going to let it go all the way to expiration. We're just not. Okay. Now, if we go back here and we say, well, you know, I'm going to get out. I'm going to get out right here. I'm going to go ahead and sell to close those, and I'm going to sell them for $17.10. $17.10. So I made $5,396 on my protective put. So what I do is I turn around and I take this money and I buy additional shares at now 258. So I'm going to buy 21 additional shares. I now have 21 plus 365, or 386 shares at 258, or $100,000 portfolio. Well, that's what I started out with. That's what I started out with. So at this point here, I decided to put that on, and I went to bed that night, and boy, I had a great night's sleep, and I felt no anxiety. For 2 weeks, I felt no anxiety, no worries, no cares. My money's protected. Don't have to worry at all. And lo and behold, at the end of the time period when I decided to get out, I take that money, I buy more shares, and my portfolio is the same. But now what's interesting is I've got 258 shares now. Excuse me, I've got 386 shares versus 365 shares. So I'm now back in the market with more shares. Okay, I've protected my portfolio, but now I have more shares when the market goes back up. That's a break-even proposition versus taking a 6.4% loss. Now, I don't know about you, but I don't like taking 6.4% losses of my portfolio. I just don't like it. All right. So, in a nutshell, what you want to do is you want to protect your portfolio by hedging. Now, a lot of people have come to me, a lot of my mentees said, you know, this is fantastic, Dale. I don't quite have a portfolio that's big enough at this point in time to utilize this. But boy, this is a pretty awesome strategy, and it's so simple. Can I use this as a standalone to buy puts? Absolutely. Absolutely. Does this also tell me when I shouldn't be buying calls? Absolutely. Okay, there's a number of ways you can use this. Question coming through: if you fail to close or buy back the puts, and if they go in the money at expiration, will you be assigned the stock? Not for a put. You're putting it to somebody. You're putting it to somebody. Nope. Okay. Now I want to take you. I've got some time left here to take you over to my website, and I want to take you on a little bit of a tour. Remember that website is https://optionsinfinity.com, and I hope Renee will put that into the chat box so you can take a look at that later on. But let's go over to the website and take a little tour. Okay, this is the home page. https://optionsinfinity.com. The home page comes up, and the first thing is you might want to be a free member. Well, free member, all you have to do is put in your email and you get access to all this education. Option leverage, psychology of trading, how I set up my charts, what's the proper trade size for your portfolio, trading psychology, what is the regression channel, a little bit more about the Fibonacci's. Macro MACD is something that I developed. It's the daily version of the weekly MACD. Money flow in the EMA, okay? The other thing you have access to is I have a number of courses that are available to you, and these courses are, you ought to treat your trading like a business, how to create your business plan, how to be careful around earnings. We're in earnings season right now, how to do that, and a little bit more about hedging, okay? You can also click on blog, and I've got a number of educational blogs on there. Like I said, we were rated #1 by an independent corporation, FeedSpot, as the option trading blog. Now, this was #1 in the world. We're very proud of that. But here's some of the examples of the blogs, and these are like 16, 20-minute long blogs. Trading economic news, proper trade size, financially strong stocks, trading peak performance, 8 winning concepts of the super traders, Think and Grow Rich. That's a book report I did by Napoleon Hill. That's a fantastic book. Trading the Iron Condor, Credit Spreads Demystified. These are all available to you. Okay, now we'll go back to the home page. Because if you scroll down, and so you can spend, you know, as long as you want on my website and learn glean as much information as you can. See if what I'm talking about makes sense to you. See if it makes, if you see it fitting into your trading plan. And then if you decide, you can become a member and either join me in 2 programs that I have, either Options Pro or SPX War. We specialize in trading credit spreads. I think credit spreads is the way to go, especially during volatile times like we're in right now. The premiums, the market makers have such high premiums on time right now. that when you sell an option, you're capturing that premium and it decays rapidly. We're using that strategy, but we're always buying another option back for protection against a catastrophic drop in the wrong direction. It's credit spread. It's a credit spread. SPX War, we've been doing this for it's been public for about 2 years. And at this point in time, we have a little bit better than about 84% winners. That's unheard of. It's unheard of in the industry. It's unheard of in the industry. We trade the weekly options. We trade the SPX. It's the big boy. We trade weekly options. On Options Pro, we use similar strategies, but we're trading the big five. We're trading Amazon, Google. Used to be Priceline, now it's Booking Holdings. The RUT and the SPX. We're trading those fives a little bit longer. We're putting on credit spreads a month out. These are 10 days out. A little bit quicker, same strategies. Quicker, longer, same strategies. Thank you, Nina. Nina just signed up. That's great, fantastic. Okay, so let me just go in and today, I was talking about hedging for you, and our newest feature. We love to give stuff away. I love to teach my mentees. We've got a new feature. We are giving away for free our ETF hedging course when you join either Options Pro or SPX War. We're giving that away for free. Okay. Well, what do you get when you go into either one of these? You get 4 modules where I explain exactly what it is that I do, how I set things up, how it's been traded, the past results. Okay. Then every Monday, every Tuesday, Thursday, and Sunday, I do a nightly trading session review where I review the trades that we have on, what I see in the future, how we're managing these. And then once a month, we get together on the second and third Tuesdays of the month. And it's a Q&A session, basically. It's open for you to ask questions. I'm the moderator. I go over the rules, the previous trades, we take a look at it, and then I open it up for questions, and it's run by me. Plus, whenever I make a trade, I send out a real-time text and email alert to you. I am not a registered investment advisor or a licensed broker. So when I send out an alert, it is what I am doing. I want you to go onto your trading platform, take a peek at it, see if it makes sense for you to go ahead and do that. Okay, so that's 4 things that you get when you become a member. There's a sample trading session review, just some testimonials. And you scroll down here and said, did you attend today's webinar? If you did, we're gonna give you a discount today. Okay. So if you like what you heard, and this is going to be good for 10 days, it gives you a chance to get on the website, take a peek at what I've got, what I do, the education that I've got there, talking about credit spreads. Look at that, see if it makes sense for you. If you like what you saw, you got 10 days to sign up for either Options Pro or SPX War and claim your discount. Okay. All right. So let's see. Let me see if there was a question that I missed here. No, I think I've got all the questions. Does anybody else have any final questions for me? I've got 3 minutes here. Any tips on hedging Amazon for tonight? No, my tip on get the heck out. Amazon has earnings tonight. Now, a lot of times Amazon and Google will go together, and you saw how Google got clobbered the other day. It actually came in with earnings better than estimated, and it got clobbered. I never put on any credit spreads or any trades before earnings. And I've looked at a number of ways, and actually, you know, I've got a blog in there about how to trade earnings, and you know, you can put on iron condors, you can put on strangles and straddles. There's a number of ways to trade earnings. The best way to trade earnings is stay out. Just stay out. Okay. And wait for the market, wait for Amazon to tell you. See, remember, when you go into earnings, the earnings, that's past data. The market trades in the future. So the market is interested in what the CEO and the CFO are going to tell you. And if their earnings are fantastic, and the CEO says, yeah, but you know, it looks like it's going to be a little weak for the rest of the year, it'll get clobbered. Okay. Just the opposite. If the earnings look fantastic and the forward guidance, or if the earnings look terrible, but the forward guidance is we're going to do this, that, and the other thing, it might have terrible earnings and it'll shoot up like a rock. So, but any tips on hedging tonight? No way. Get out. Okay, you're welcome. You're welcome. Let's see how to calculate future loss coverage. How to calculate. Let me see if I can understand that a little better. How to calculate future loss. Well, you know, I'm not sure I fully understand that. For future contracts? For future contracts? Well, I'm not dealing with futures contracts. I'm just dealing with the SPY, which is an ETF, And you know, one of the beautiful things about an option is the most you can lose is what you paid for it. Okay, and remember, if the market goes against you and it starts going up, you have a put on. You can either take it off or remember that your portfolio is making money when the options lose a little bit, so there's no hurry to take it off.